Welcome to this very special edition of the KJ Masterclass Live, the show which ensures that you profit from your time spent here with experts, either through their industry insights, information, or simply learning from them. And today we have with us Ivan Pavlovic. He is a self-educated author of Making Money on the Print Money Printer. We'll talk about that. We'll talk about the system that he says that is designed to erode our wealth, and we'll understand how money is created to smart strategies for investing in distorted markets. Welcome to the show, Ivan.
Thank you very much, Ajay. Looking forward to the discussion.
You're welcome. Welcome to the show. Welcome to India in this online form, Ivan. And I'm sure not just in India, but a lot of people across the globe will benefit from what we are going to talk right now. We'll talk about inflation. We'll talk about smart investing. We'll also talk about other forms of, financial systems. So we'll talk about that. But before that, let's understand a bit about your journey, your background, so that the audience knows who they are listening
to. So I'll keep it brief, but originally I'm from Croatia, from Zagreb, and in Croatia it's normal that you like everywhere you live with your parents until a certain age, and then you want to usually after university you want to build up your life. And so the issue there for me was that I saw that economic situation wasn't very good, and of course Croatia had a particular background because we had war between 1991 and 95. And so that impoverished the nation, as all wars impoverish the people. And so, but after that, of course, the situation became better. But nevertheless, I felt a bit stuck. And also, speaking with my friends there, we all felt a bit that way. So I was looking for some other opportunities in Europe, and so I moved to Luxembourg, which is one of the wealthiest European countries. And in Luxembourg, I've done some additional studies. I studied law, both in Zagreb and in Luxembourg. So I have legal background, and then I lived in Luxembourg for 6 years. And then after that, I lived in Ireland for a year, and now I'm in Portugal. I've been here for 2 years near Lisbon. And so what I learned in this journey, and this first sort of became clear to me while I was in Luxembourg, where I was supposed to have, a better life than in Croatia and everything. That was the primary reason, of course, why I moved, was that I felt every year that I'm not progressing that much. I'm not moving anywhere in financial terms, right? So while I could afford a bit better living standard than if I was in Croatia, so, rent out the apartment and rent or a car or buy some cheaper car and of course pay my bills on my own. It was from year after year, even though the salary was rising, so my fixed income was increasing, if you will, I could afford less and less. And so it was not clear to me how is it that and by the way, I worked in financial industry, and I still do. So it was not clear to me how is it that somebody, young with even few years of experience, working in one of the most lucrative industries in the world, in one of the wealthiest countries in the world, in Luxembourg, cannot, just simply afford really like anything better after a couple of years of working. So I was approaching the age of 30. Now I'm 34. But back then I was approaching the age of 30. And I just felt that the original reasons why I moved were not being accomplished. My goal was not being accomplished. And moreover, it was not clear to me how is it then that, we are supposedly living in capitalist society. And so how is it that somebody gets rich actually? How is it that people can get to acquire certain wealth if, an average person basically stands no chance to significantly improve their life. And doing just very simple math and simple calculation, I just realized, I would have to basically work for the next, 30, 40 years maybe, just to be able to afford a small flat, like a 2-bedroom apartment, to pay it off, right? You can buy it by taking a loan from the bank, but then you're repaying it. So it's kind of like you're renting your apartment really to the bank until it becomes yours. So, and then what, after spending your entire life, you have like a 2-bedroom apartment. So that was a bit unclear to me. And I was wondering, well, if it's like this in Luxembourg, so, how can even people in other poorer countries stand a chance? And so I learned that, through internet. And this was a big thing for me, internet, podcasts, and then subsequently books that I started reading and material, where I figured, okay, you know what, I need to learn more. I can't go on like this because obviously things that I was taught in school and just by standard education while growing up were not working for me. And so I, started reading random authors. One of my first book was Robert Kiyosaki's Rich Dad, Poor Dad, which is, I think, quite important for a mindset that one should have, to read and to grow and to educate yourself. I think that's the primary message of that book, to financial education. So I realized, okay, I don't have any financial education really. My job, although I work in finance, was always more of a regulatory nature, given that I had a legal background. So I started educating myself about finance, learning about investment funds and other products, asset classes, etc. But on top of that, I started following some channels that were explaining, all these things that why they were happening. So like this, basically, I entered economics, and that's funny because when I was, younger, I never really understood what economics was. And, sometimes asking people who studied economics, like, for their education, like for university, they didn't really know how to tell me, like, it's about learning about how economy works. But like, I'm still not getting what really economy is and economics and everything. And then just when I started diving into these things, I learned that economics is really just about how society uses the scarce resources. So we have resources, human resources, natural resources, etc. Time is a resource, right? But all these resources are scarce, meaning they're not. We can only choose what to prioritize at any given moment, right? And so economy is really just kind of the science that explains how people use these scarce resources, how they act under different conditions, right? And then by learning this, I realized that economics is not like physics, where you have certain rules set in stone, and if you do A, it will inevitably lead to B. I realized that this is a bit how it's being taught today in schools, at least in the West, but I think it's prevailing understanding among most of academic educators. So I realized that what is being taught as economics today, it relies on so-called Keynesian economics, which is had been given name according to John Maynard Keynes, who was an economist of early 20th century. And so basically he was very famous, charming guy. He had lots of youngsters following him. So he was very influential. And basically he got the popularity after Great Depression that happened in the 1930s. There's no firm time frame, but more or less around 1930s. And so I realized that he put in place lots of these formulas and mathematical understanding of through statistics and everything, how economy should be viewed, and through this how it could be then managed. Because of course, if you have some numbers and how what certain rules are, then with if you give the government the power to control certain things, certain parameters, you can influence economy. And so then through this, I realized, okay, we are being centrally managed. And after that, I realized that we had these entities called central banks. I mean, of course, I heard of these entities before, but I never really knew what they do. You know, you always hear some fancy terms on television or something about currency conversions, whatnot, and you're thinking to yourself, okay, I don't understand these things. These guys know what they are doing, right? And then I realized that they don't. Well, perhaps they do, but they do things that are in their favor and in favor of, you know, certain connected groups. And so basically through this, I learned about inflation, right? Because inflation is about money, and money is a part of monetary economics, right? So economics as a science is speaking of lots of different things of how we trade, etc., how we use resources, how we can progress. But one part of economics is money, and this is probably one of the most misunderstood parts of it. And so this was a bit my let's say beginning journey, but I'm going to stop myself now because I could speak like this entire time. So I don't know what in particular you would like to, you know, ask me further about this.
Right. Ivan, we'll come to your book, but first let's understand that when you talk about, you know, financial system, and you talked about that, you know, almost that we are being rocked by the system each day. Why do you say so?
Okay, so traditionally, the question is how we get money. What is money? And this is one of the most important questions here to understand. And it's not, I cannot explain it within 1 or 2 minutes, because there is not one single thing that is money. Money can take different forms. This is what's most important for your viewers to understand, because it's just something that, you know, people exchange with one another. Money is ultimately a form of commodity, if you will. So all things, once you understand, you know, investing, trading, whatever, all things kind of trade in relation to each other all the time, right? Supply and demand. This is what economics is about. And so is with money. So the key thing about money is that it has to be scarce in nature. You cannot just have, you know, unlimited number of it, because then, you know, basically that means infinite supply. So that's not really money. People need to have, why? Because people need to have confidence that it will store their purchasing power. So if something has unlimited quantity, then its quality can constantly go down. So that means that I cannot save. So it means that if I'm paid, I want to immediately get rid of it if I cannot save, right? I want to immediately purchase something else. So that's why to have something as money, it has to have purchasing power, store purchasing power. And so those different commodities, people experimented with lots of different things in the past. So the commodity that becomes used the most becomes money for trade. And so people acquire that commodity, such as gold, just even though they don't need it, but so that they can spend it to buy something that they need. Okay, so this is how it naturally works within economy. But then you have basically governments and, you know, their territories, the states, that impose on their territories their own currencies. What are currencies? So these are, you know, papers that we use, or in modern times digits, that we are forced to use in transactions. So we cannot choose not to. And so then what happens is that they can manage those currencies at their will if they're not restrained by laws. What do I mean by this? So traditionally, if you when the institution of banking first developed, and this was mostly prominent, you know, around 14th, 15th century, you had you were able to deposit your money, such as gold, into the bank, and bank would give you a certificate of deposit. And basically, at any time, you could go back and take this take this gold in exchange for that certificate of deposit. It's the same as if you're going to a nightclub and you leave your code there, and then you get a certificate. Well, it's your code. You can come back and get it at any time. And so, what banks are not stupid. They're very smart people, right? Bankers. So what they realized is like, well, if all these codes are the same, right? If all the gold looks the same, if it's all the coins are the same, well, not all the people will come at the same time to pick up their coats in a nightclub. Not all the people will come back and ask for their gold. So what we could do is we could actually be lending more than we have on deposit. And so this is how this fractional reserve, so-called fractional reserve banking, it's a fraction that they keep in reserve, developed. And so, of course, in the longer run, people get afraid that if they see lots of those paper certificates floating around, they get afraid and they see, okay, wait a minute, does this bank still have my gold? Because I see so many certificates and there's not that much gold there. So actually, I want to go back and take my gold just to be safe. But if enough people realize that their savings might be threatened on the deposit, they all might rush in at the same time, or even a certain percentage of people, right? So if bank only keeps 10% of deposits, stored, and you only have 20% of, or 11% of depositors coming and take their gold, right? So not even all of them, just 11%, just more than they have, the bank can fail. And so what they realized in this crisis, through 20th, 21st century, that they just need a backup for this. So they realized that if we would have something that would safeguard those bank runs, so run on banks when people run to take their deposits back, if something could just refill our deposits, then we would not go bust. We would not go bankrupt. And so what they put in place was the mechanism of central banking that was there to prevent banks from failing. But why is this important? It's important, and I can tie it now to our discussion about the state that mandates the use of its currency, right? So in India, you have a rupee, right? So you are mandated by the government to use the rupee. And so what happens is that you use rupee. But how does rupee come into existence? Through the central bank of India. That's right. So the central bank needs to create it first. But it doesn't give it immediately to the people to spend it, of course. But rather, typically, the way it works, again, I'm not an expert on India, but usually the way it works with the central banking and the money creation is that the central bank creates it by, printing certain number of digits into computer. And it gives it to the banking system, to the ordinary, everyday banks. And those ordinary banks can then lend this money because now they have the reserves that central bank gave them. Okay, this is the first step. So this is the opposite of how the money would normally be stored in the normal bank. So normally somebody would have to produce something, such as gold, dig it out of the ground, refine it, and bring it to the bank, or something else like wheat, if that would be considered as money. But in this case, bank doesn't have anything. It just gets these digits or paper, if you will, from the central bank. And now it can lend it. But if the bank doesn't lend it, then all these subjects in Indian economy will not have anything to spend because they cannot transact in anything else than in that money, than in that currency. So what has to happen as a next step is that the ordinary banks lend this money to someone so that it can be spent. Now you will naturally be asking, well, if the money is lent, it has to be returned, right? Because a lender does not lend unless it wants to the money returned. And so, if the money is lent, it has to be returned, but of course with interest. And so then you have the question, so where does this interest come? How does the bank make interest? The answer is, there has to be a new loan issued to someone else so that there is no more currency in circulation, so that the bank can get repaid, basically, and that subjects have enough currency to transact in. And so the money can lend this, the bank can lend this money either to the ordinary subjects, such as you and me. We want to buy a house, we want to buy a car, we want to go for a ski trip. We come to the bank and we ask for a loan. And this is how the money gets created from the bank. Now, what we call money. And the proper term for this is really fiat currency, right? You've probably heard this one before. And the B option is that the government borrows the money from the banking system. And so the government can borrow money from the banks and pay its duties. It's, people who are pensioners or who work in the government, they can be then paid because, if the government didn't tax the nation, but it borrowed the money, it can just then distribute this money further on. But now, of course, the future subjects will have to repay this through taxation. And so why is this theft? It's theft because first, you are basically bound to constantly get loans, to borrow money, and to repay them with interest. So you're kind of working for someone constantly. You're working for the government, for the banking system constantly to repay loans. If you don't do this, what happens is that because of constant borrowing from other people, other people will be borrowing, if not you. So the money supply, because of all those loans, will be increasing. And if money supply is increasing, then the asset prices will be rising as well. The cost of goods will be rising as well, right? If you go to the supermarket now, there is more paper chasing the same amount of goods. And so that's why even if you're saving, you're not getting a loan, everything is becoming more expensive. So basically your purchasing power is being stolen from you. So that's why the system is basically designed as a theft. And of course, if those that receive the currency first, they benefit the most. So somebody who, the banking system and the government, basically they are the closest to the issuance of currency. So the governments benefit because they will get, to pay their subjects, people who have benefits, etc. They will take the loans, they will distribute that paper, and then only afterwards, other people can go and spend, and then the price of goods will start rising, and then they will be losing purchasing power, right? So that's a little bit about how the system is designed and why it's theft.
Right. So isn't the same system designed for everyone almost in all places? There are central banks. Somewhere or the other, you have to one or the other system in place. So should we understand that, that this is all deliberate way of almost robbing people, or is it inflation is a reality in today's time because of the cost of living, demand and supply of the same things, and that's the way it works? Or is that how do you like to help people to understand this part?
I think one very important thing also to understand is what, and maybe I should have started with this, is what is inflation? Because usually when we hear the word inflation on television, it means that prices have risen. Something became more expensive. But that's not at least original definition of inflation. The original definition is inflating the money supply. You're inflating this balloon, the supply of money,
Okay.
right? And so you cannot inflate prices, like prices go up and down, right? So you're inflating really the supply. And so the inflation is not, of course, a phenomenon of modern times only. This is very old phenomena. So, in ancient Rome, you had Caesars who were printing, well, I will not say printing because they didn't have paper, who were debasing their currency, but in a bit different logistical way, because so they used gold and silver as money, copper. But so the way they would steal the purchasing power was that they would blend those metals with other metals of lesser quality. So instead of giving you, in paying you in a fully gold coin, 100% gold, they would mix this gold with something else, some other metal. So then maybe it would be like, 80% gold in that coin. And then 10 years later, you would have 70% gold. And then, 10 years later, 50%. And so then ultimately, people would realize that this is happening. And so they would start hoarding the coins that were of better quality and spend others that were of lesser quality. And so people who were selling goods, if you were a blacksmith or I don't know, you were creating, shields and armor, you needed steel, you had expenses in those other commodities, right? And so if you were receiving commodity, so money of a lesser quality than before, you were simply asking for more of that commodity now to replace it. So that's why price would keep rising, right? So their money was like denarii and denarius. So they would just simply start asking for more denarius, like we do before today. So it's if some, I don't know how much Coca-Cola. I think it's a great example because. So I don't know what's the price in India, but like I can tell you in Croatian kuna. So when I was a kid, half-liter Coca-Cola on kiosk was 5 Croatian kunas, and that's something like 70 cents in euros today. And today I have to pay more than double for that same Coca-Cola in Croatian kunas. Of course, Croatian kunas don't exist now for the past year or two, but that's just my point, right? And that's simply because you had more kunas in circulation. You have more euros, more rupees in circulation. The Coca-Cola is still the same, but there is more currency chasing it, And so even despite technological improvements, which should make Coca-Cola cheaper actually than before in nominal terms, it is more expensive. And so basically, as the world developed, and even in the previous century, you could still, when you said that the whole world today is, I think so. I think most of the countries that are either in development or certainly developed economies, they have central banks. And, before you could, let's say, hide more easily into another country. So, in Europe, for example, Germany was very known for even though it had a central bank, but because it learned from its mistakes before, it had Weimar Republic, it had hyperinflation in the 1920s. And that was, one of the reasons why Hitler came to power was because of severe economic situation. And so afterwards they learned, okay, we must not debase the currency, at least not a lot. And so they were, for example, very prosperous country then in the 50s, 60s, etc., because they were hardworking, but they could save because their currency, the Deutsche Mark, was a very trusted currency. Even the foreigners would go and save in German in this currency, put in money, their money in German banks, because they would be certain that this will store their purchasing power, and of course with interest that this purchasing power would grow. But so in European Union, for example, today, all countries in Europe have the same currency. So before, if you were in Croatia and you were not satisfied with Croatian kuna, you could switch into German mark. But now you have less choice because the whole Eurozone is under the same currency. But of course, now you can still move from euro to dollar to rupee to yen, etc. But I think that while this is important, that people are aware of these different currencies and that they don't necessarily have to have all their money in their own currency of their country. I think that well, at least in the West, at least in Europe, lots of people are simply not aware of this history of what governments do with money when they need to spend more than they can tax, than they're willing to transparently tax from their citizens. And so they don't buy gold. I think India is quite aware in this relation. Like I heard at least that Indians traditionally own a lot of gold, like retail. By this I mean like ordinary people, not only the institutions. So that's, I think India in this relation is quite aware and intuitively at least Indians understand the value of storing purchasing power in something tangible and something that is durable and scarce in its nature.
Absolutely. Gold has been part of our traditions because we use gold in marriages as gifts and all. So that's been centuries and centuries old tradition, which has by default, culminated in, this sort of a understanding. So every household has a little bit of gold for themselves. And that's the way it has been. So it's a good thing. It's a good thing. But for a common person, what is the best way then? How do you protect yourself in today's time? Very quickly, if you can tell that.
Of course. So again, investing itself is a bit like, you're predicting future. So you cannot fully guess the future, and you cannot, I get this question, what is the best thing I can do is like, and I say, I don't know, because there is no one single way, there are more paths to the top of the mountain. And especially because inflation is, of course, it's one of the predominant reasons of losing purchasing power. But when it comes to markets and investing, there are lots of other factors that impact those markets. And so one way to look at it is within your own country. So within India, you are being, let's say, you're being robbed of your purchasing power through inflation. So yes, there are ways traditionally to protect yourself by basically storing, exchanging that currency for something tangible, right? So again, gold is one thing, but it's not the only thing. There are other commodities that have real value, so you then need to see and look, okay, what is the price of this commodity compared to other goods? What's its supply demand? Is it valuable? Is it valuable to someone? Does somebody need it for their future? Like, it can be oil, it can be coal, uranium. There are lots of these different commodities that people can have. I think a very intuitive way that people do it is also by buying simply houses. So, this is why real estate usually tends to perform well in inflationary environments. However, then, secondary effects are those external ones from outside of your country. And because we are so connected in today's world, it's very different than 200 years ago. The whole world is much more connected, especially as a consequence of globalization, in the last 100 years. And so something that is happening in the United States or Europe can also have, of course, big effects on citizens in India. So in that sense, businesses can perform well in India, or because of something that's happened in Europe, with banking system or etc., it can spill into Indian system, and so then the businesses can also suffer in India. So I would say that also, people need to be aware that macroeconomics and geopolitics in today's world is very important part of being an investor. And so, long story short, I think that the best thing that people can protect themselves is to first educate themselves, because the more you know, and the more open-minded you are to different points of view, because there is so much tribalism on internet, on social media, everywhere, between different, people get religious about assets. They get religious about Bitcoin, about gold, about, I don't know,
Right.
stocks. And so I would say that something that I learned is just be open-minded, learn stuff, learn different points of view. I'm currently a proponent of Austrian economics. It's gotten its name because of early people who were, representatives of those thoughts, such as Ludwig von Mises. They were Austrians, and so this is why it's called Austrian economics. And this Austrian economics, unlike Keynesian economics, basically says, look, people are very individual. They have their individual preferences. You cannot control them. You cannot control them through central entities. And with money, Austrian economics says, well, we should have sound money, meaning, you should not be able to print more than there is stored, right? Or create anything in additional than already exists. And so I think that, education is the first step. That's why I decided to create this book, because I thought that there are so many good authors there, and that it's not so hard actually to get educated. I think the hardest is to begin, and moreover, to be kind of pushed into right direction. And also, of course, people are very busy on a daily basis. They lose a lot of time in traffic. They get irritated. They lose so much energy just by, until they get to their job. Then at their job, they have to deal with lots of stuff. And then, of course, they have their private lives, families, maybe a little bit of sport, etc. So there is just so little time left in the day that you're not really willing or sure how to begin. And so I created this book based on, years that I spent listening to thousands of different podcasts and hosts, but also reading lots of different books and authors, and just trying to connect all these dots, and see if, this argument and counter argument makes sense, right? And I'm still learning. I'm not, I haven't stopped. I think there is really a lot to learn. But you have to be willing to, just even if you spend just half an hour a day, in 2 or 3 years' time, you can be further than 90% of people, in my opinion. Because, and again, I know we have to keep this short, but even the financial system today, Wall Street and others, they are focused on short-term trading. They will not invest money and really wait for 20 years. For something to happen. They make money on assets under management and other fees and commissions, trading commissions. Brokers do the same. So the system is benefiting from having basically people's money circulating within the system, which is not a bad thing, right? We need investments, but at the same time, I just think that also lots of those professionals, not all of them, but a lot of them, have simply they are on autopilots and on some algorithms and everything. And then this is why I think they can easily miss the big picture and have big losses as well once these arrive, because they are cyclical. Cycles do exist. I write about this in my book. Austrian School of Economics warned about the business cycle, which explains how the whole economy goes up and down. So not just isolated events such as wars or famine or something that can impact certain sector, but why is it that suddenly while everything is fine and nothing special occurred, you don't have these unforeseen events, how is it that the economy is suddenly like quickly going up and then suddenly it's quickly going down, and lots of businesses are disappearing? So, and the consequence of this is a manipulation of money through central banking, through debasement of currency, and basically through impact on interest rates. And so again, I cannot go here in depth, but I've put all these different things in my book, and it's really centered about how inflation impacts markets and us on a daily basis.
Absolutely. There's much to learn about all these things, and I'm sure a lot of people would want to connect with you, Ivan. So what is the best way for them to do so?
So I do have a Twitter handle, although I just recently created it, the Twitter X. So it's IVANN, so my name, but just with one additional N in the end. So IVANN dot PVL. So IVNN dot PVL. I mean, I'm not, otherwise I don't have, websites or something else. I'm not offering any services at the moment. I would recommend everyone to, go on Amazon. It's available on all Amazons, including, of course, Indian. So making money on the money printer. And, you can, it's not very thick book. It's like 240 pages in total, but it's really, I think, around 200 pages to read. 10 chapters. You can read, one chapter a day, and it's a very quick thing to get up to speed.
Right. With this, it's set up on this very special edition of the KAJ Masterclass Live. Thank you so much indeed for joining.
Thank you very much, Ajay. Bye.